Namaskar. This session we will be discussing about India's foreign exchange reserves and the composition of reserves, the determinant of foreign exchange reserve, and we will also discuss about whether India's forex reserves is optimum in nature. If it is not optimum, what should be the ideal reserve? And while deciding about optimum reserves, which are the component, which are the determinant we have to consider, in that also we will be discussing in this session. Let us start with the session. So, before going to the discussion of these optimum reserves, we have to understand that how the foreign exchange reserve develop, how India or any other country receive foreign exchange, and also what is the outflow of foreign exchange. When you consider the foreign exchange reserves, we have discussed in our earlier session that the balance of payment, the country's balance of payment has two parts. One part is called the current account, another part is called capital account. In the current account, the day to day transaction of foreign exchange take place. In the capital account, long term movements of foreign exchange take place. In day to day transaction of current account, generally we have merchandise export, that is export imports are the current account composition. Export provides us the foreign exchange. Similarly, we have invisible receipt provide us the foreign exchange. Invisible receipt we have travels, tourism, transportation, insurance premium, government accounts, the miscellaneous expenditures which are day to day in nature. Similarly, in transfer side we have official transfer and private transfer. Similarly, we have income side, that is when the government of India or the any company invest in abroad, particularly give loans or purchase abroad certificate, bonds, that also will give some kind of interest payment, some kind of dividend payment, and that also part of the investment income. Similarly, our NRIs, the non-resident Indians, they are working abroad, their compensation, their employee, their salary is a part of the income also as a compensation to employee. In that current account, we have the export providers foreign exchange, invisible transaction providers foreign exchange, transfer of payment also provides us foreign exchange, and income provides us foreign exchange. So, these are the sources of current account activity which provides a particular country the foreign exchange. Similarly, in the capital account generally India or any other developing country receiving huge amount of foreign direct investment, foreign portfolio investment, that also part of the exchange reserves. So, in the foreign direct investment in the form of establishing company, in the form of partnership of a company, that foreigners come to India, establish the company or existing company, they do the joint venture, from there we get the foreign exchange. In the portfolio investment, generally the foreign company invest in our stock market, the purchase of our domestic bonds certificate, that also a source of foreign exchange. Similarly, loans, government of India, corporate get loans from abroad, both short term loans, currency borrowing, long term currency borrowing, medium term notes borrowing, these are also parts of the current currency reserves. Similarly, external assistance, government of India gets external assistance from some of the developing international development associations are there, they provide foreign exchange, external assistance to government, to NGO, to different private body, that also part of the foreign exchange a country generally receive. Similarly, we also receive the commercial banks are in India, they also transact, give lending, borrowings, lending, credit, loans, they also get the foreign exchange. Similarly, they also accept foreign deposit in the form of FCNR account, foreign currency non-resident Indian account. They also borrow from the abroad market in the form of bonds, in the form of commercial borrowing, that also part of our foreign exchange reserve. In the capital account, the significant part of the capital account is the portfolio investment, it is the foreign direct investment that provide significant amount of foreign exchange reserve in our country, particularly in Indian context. Similarly, if you see that sources of foreign exchange, after discussing about the current account and capital account, part of different segments of the current account, different segments of the capital account, the sources of foreign exchange you can identify are the merchandise exports, software services export, financial services exports, the other business services export, similarly travels and tourism, salary and compensation to Indians and working abroad, similarly official transfer, private transfer, interest, dividend on foreign assets, foreign institutional investment in our equity market, foreign institutional investment in our bond market, similarly foreign direct investment, foreign direct reinvestment, the external assistance, foreign currency loans, foreign currency borrowing, banking sector transaction in foreign currency, all parts of the foreign exchange reserve, all contribute to the foreign exchange reserve. Which are the significant source is the export, significant source is the travel tourism, significant source is our salary and compensation to Indians working abroad, significant source is the foreign direct investment and foreign portfolio investment. These are the significant sources of foreign exchange reserve, and which these sources has been contributing over the year in our foreign exchange reserves. So, when we outline this reserve over the years, prior to 91 our foreign exchange market was not developed, foreign exchange sources were very minute in nature. After 91, 92 Government of India liberalized the foreign exchange part, we have adopted what is called the liberalized exchange rate system, market determined exchange rate system developed in India, and that provide impetus in foreign exchange inflow to India. We have also liberalized our portfolio investment side, we have liberalized the foreign direct investment, we have decontrolled the license regime and allow the foreigners to invest in our development of company, invest in our joint venture, invest in our stock market, purchase our domestic bonds and equity. These are, and we have opened up our sources of investment, foreign investment. After 91, 92 the foreign exchange market developed and it provide different kind of items or different kind of investment product in foreign for the foreigner to invest in India. So, if you analyze the foreign direct investment, portfolio investment and also the foreign merchandise investment over the year, let us have a look at what is the development, how the sources of foreign exchange market, foreign exchange develop over the year. Let us start with from 91 to 2000, the 10 years service. 10 years, if you see, the merchandise account was negative in 91 because our exports not pay for our imports, our imports are more than our export. So, we generally have negative in our export import, but in the invisible account was not developed in 91, 92 because of this invisible is negative. Similarly, current account deficit is also negative. However, India received some kind of minute level of foreign direct investment, that is 97 million in 91. FI investment almost negligible and forex reserve was 5,834 million US dollar. This is very minute level which is not sufficient to pay for our 1 or 2 months of imports requirement. So, if you see the foreign exchange reserve in 91, we are almost negative in nature because our merchandise export requirement is much more than our foreign exchange reserve. And realizing this, Government of India liberalized the foreign exchange market and try to open up the foreign exchange market for what is called the foreign investor. And after that, there has been development of foreign exchange market and there is a growth in foreign exchange reserve. If you see the data set, 92 onwards, though our export import merchandise accounts decline, the negative part is declining, invisible increasing significantly over the year, and the current account, though it is still negative compared to 91, 92 is still negative, but negative part is reduced significantly. We receive significant amount of foreign direct investment and also foreign portfolio investment. In 93, 94 onwards, there has been significant growth in invisible, there is a significant growth in foreign FDI and also FI investment, and this has given impetus some kind of activity in our forex reserve, and forex reserve started increasing after 93, 94 onwards, and it has been in 2000. If you see, there has been significant improve in foreign exchange reserve. It is almost 38 billion compared to a 5 billion in 91. So, 10 years we have migrated to somewhere from 5 billion in 91, 92 to 38 billion US dollar in 2000. If you see the growth in the foreign exchange last 10, that is a 10 year service 91 to 2000, it is the invisible and the foreign direct investment and FI investment. But however, our export is increasing definitely, but our import also increasing faster than our export. We have merchandise account which is negative in nature, that is export minus import is negative. However, invisible and foreign direct investment, foreign institutional investment contributing to our export kitty, and this has been significantly contribution in our foreign exchange reserve. If you see the growth path, if you see the graph here, the invisible is this one, this is foreign exchange reserve is increasing, and invisible is a blue line. The blue line is invisible. This has contributed significantly in our foreign exchange reserve. Similarly, current account, though it is negative, but negative is controlled significantly. Earlier it was quite negative in 91, 92. It has been controlled by 2001, 2000, and however, that foreign merchandise account is declining over the year. Our export, this signifies our export is not in a position to pay for our import, which is a difficult situation for India, because if you analyze the Indian export import basket, our exports are primarily traditional goods and services, which is not significantly contributing to our export earning. However, our imports are inelastic in nature, and their essential imports are oil import, which is the significant part of our import basket, almost 60%, and this has contributed to our negative part of the merchandise account. However, our current in foreign exchange reserve is increasing because of the invisible side of the individual part of our contribution to our foreign exchange reserve. If we analyze 2001 to 2012, that is in later part of the financial sector reform part, that is consolidation part of the reform, that if you see the merchandise account still negative and growing significantly. However, invisible is growing faster than the merchandise account, and invisible almost contribute what is called almost 50% of our foreign exchange reserve. Similarly, our FDI also increasing. The FI investment, though fluctuating, it has also increased over the year, and foreign exchange reserve from 2001 it was something around 42 billion, increased to nearly 294 billion in 2012. Then if you see in 2011 it was 300 billions, which has been reduced because of the financial sector crisis all over the world. In India, our export earning reduced, and because of this reason our what is called our foreign exchange reserve has declined, and significant part of the contribution to foreign exchange reserve in later part of the reform, that is 2001 to 2012, it is the invisible and the foreign direct investment and foreign portfolio investment. If you see this graph of 2001 to 2012, the significant part of our reserve contribution to our reserve is invisible, which is increasing along with the foreign exchange reserves. And similarly, our current account deficit after 2005 has declined significantly, and the decline of the significant part of the current account deficit is alarming in nature. After 2006 onwards, it has declined significantly and stood somewhere near something around the current account deficit the merchandise account deficit is significant, and similarly current account deficit also significant, somewhere near the 90 billion, 85 billion dollar. That is a significant part of the current account deficit. The deficit started increasing when 2006 onward, because in 2006 onward the world is in recession period, our export earning is not good, our import requirement is essential in nature, which has been increasing over the year, and our export not in a position to contribute or pay for our import. Because of that reason, the merchandise account deficit is increasing and current account deficit also increasing. Invisible at a part of the foreign exchange reserve, though increasing, not in a position to control the current account deficit. If you see the graph in particular, see the table here, in 2000 current account deficit, current account was surplus in 2002, 3 and 4. After that it started negative, because despite there has been increase in invisible sources of foreign exchange increasing. However, the export, the import is much more, and because of this reason our export and import deficit is not in a position to cover up by the invisible sources of earning, and this has increased the current account deficit over the year. And if you see the sources of foreign exchange reserve in India, if you analyze last 20 years of data, what we have discussed here, the sources of foreign exchange earning in India after the reform measure, the invisible receipt has been increasingly significant, and the merchandise trade account, though negative and increasing over the year, the increasing export earning and individual receipt has reduced the current account deficit. Large inflow of FI and FDI have been contributing because of the reform measures, and despite large invisible receipt and growth in export earning, the continued current account deficit is primarily due to essential and non-elastic crude oil imports. The crude oil imports are essential and non-elastic in nature, and because of this reason that current account deficit has been increasing despite increase in FI investment, despite increasing in inflow of FDI, despite increasing inflow of your invisible sources of earning. And this current account deficit or the merchandise account deficit is alarming in nature in recent year, because current account deficit has crossed nearly $70 billion, and this is significantly hamper our growth and our contribute to our inflation, contribute to our what is called instability and reducing our sovereign rating. And if you see the analyze the composition last 1991 to 2000, then if you see that export has been increasing, invisible receipt has been increasing, FI also increasing, and FDI somewhat increasing, some only 98, 99 it was negative in nature. All are increasing. However, these are not contributing, these are contributing significantly to our our foreign exchange earning, foreign exchange reserve, but not in a position to reduce our, not in a position to make our current account deficit 0. So, export, invisible account, FI, FDI all are increasing in nature and contributing to our foreign exchange reserve. Similarly, if you see 2000 to 2011, that is in the recent part of 10 years, export also increasing, invisible earning also increasing, and your FI and FDI also increasing. However, the negative current account deficit is alarming in nature. Negative current account deficit is alarming in nature. And if you see the two parts, the red line is your invisible part, and along with the export, invisible also increasing. However, the FDI side is fluctuating, and 2006-7 onwards, the FDI is not significant because of the recession in the world economy. And similarly, if you see the green line, FI also not in FI also significantly reduced after 2000, reduced up to 2008, 7-8, and because this is part of the what is called the recession period, and this is a part of what is called instability in our foreign world market, and because of this FI and FDI not significant not significantly contributing to our foreign exchange earning position. Then question is here, foreign exchange composition. If you see the over the year, the composition export, FI, FDI and invisible receipt are the primary sources of foreign exchange earning. There has been significant growth in invisible after the reform measure. If you see the invisible part, invisible contributes significantly over foreign exchange reserve. It is a travel, tourism, the NRI receipt, the compensation or the what is called our Indians are earning abroad, they are sending the money, that is a part of our invisible foreign exchange earning, and this invisible has significantly contributed to our foreign exchange reserve. And if you see the over the year, though FI and FDI fluctuating, they also contribute significantly to our foreign exchange reserve. And traditional good earlier the export was primarily traditional good. Now recent year, because of our services sector export, particularly our software export has contributed significantly to our export earning. So, this new sources of revenue in export side is a software export and services export, and this has been significantly contribute to our export earning. In the growth of our foreign exchange reserve, you see 91, 92, 91, 90, 1991 onwards, last 10 years I have given you the reform measure of 10 years up to 2001, it has increased merely $5 billion to something around $42 billion, and this has significantly increased over the year. Similarly, if you see the last previous, that is 2001 to 2011-12, that is the consolidation part of the reform measure, this also nearly 54 billion US dollar to increase to 2,294 billion US dollar in foreign exchange reserve, and this has definitely give a what is called a strength to our economy and stability to our export earning, stability to our foreign exchange earning. When you no doubt we have achieved a significant development in our foreign exchange reserve, the composition has changed, the amount has changed, that has been significant reserve coming from the FI side, invisible side, FDI side and export side, whether these two from the merely $5 billion reserve in 1991, we have achieved somewhat nearly $300 billion reserve last 20 years. Whether this reserves is sufficient, we have achieved a state of adequacy of reserve, and if it is so, then what is the requirement of further reserve? Because reserve contribute, no doubt gives strength to our economy, but it has own cost, the cost of instability, the cost of keeping the reserve with us. We have to utilize the reserve in productive way, but Government of India or the RBI have not been utilized this reserve for investment purpose. They are investing it in government treasury bill of abroad, but they have never utilized this for real sector development of our country. So, whether we should keep the reserves, because when foreign exchange reserve is increasing, the equivalent amount of rupee or in Indian currency circulating in Indian market, this may create inflation in our country. To reduce the inflation, RBI is auctioning bonds in domestic market. With the auctioning of bonds in domestic market, domestic interest rate is increasing, and this is hampering our domestic growth. Our cost of capital is increasing, our borrowing cost is increasing, and this is negatively affecting our domestic economy expansion. So, excess reserve is not good for the economy, so long as the reserves are not being utilized in investment for the development of the country. So, we have to understand what is the adequacy of reserve or what is the optimum reserve we should have in for our country. So, when you mention that adequacy of reserve, it is very difficult to decide what actually contribute to adequacy of reserve. If you see the approach to reserve management after 91, 92, our approach to reserve management is not has come from what is called the balance payment crisis. We we faced the balance of payment crisis in 91, and that time we realized that we supposed to have adequate amount of foreign exchange so as to import essential goods and services. Then question is here, the traditional approach is of reserve is nothing but to fulfill the import requirement, but modern approach of reserve is nothing but beyond the import requirement. You should have a reserve which is sufficient to pay for our short term liability, which are denominated in foreign currency. So, the approach to reserve management as a part of exchange rate management. So, when you have because prior to 1991 we were not the market determined exchange rate regime. At present we are market determined exchange rate regime. Any fluctuation of reserve also have a effect in our market rate of exchange rate, market rate of rupee, and that also affect our export earning, import earning. So, if to understand that is a reserve management, should not confine to balance sheet management only. The reserve management should have a wider perspective. The perspective should be not only to cover the import requirement, but also to pay for our short term liability. At the same time, you have to address the speculative attack on Indian rupee or excessive fluctuation of Indian rupee or excessive what is called any excessive depreciation or appreciation of Indian rupee, because any appreciation or depreciation which is beyond the purchasing power, which is speculative in nature, affect our export, affect our import. So, when you discuss about optimum foreign exchange reserve, we should also take into account not only the balance sheet crisis, but that import requirement, the short term liability management, also you have to take care the management of exchange rate in market. So, when you consider exchange rate market management, we should understand that the traditional approach is not adequate at present. So, because of this reason, Government of India and the RBI realized that we should develop what is called a optimum reserve requirement policy, and for this they appointed a committee, what is called the Committee on Balance of Payment, that is Professor Rangarajan, and as a chairperson of this committee to develop the criteria for optimum reserve requirement. They mentioned that the approach to reserve management as a part of exchange rate management and external sector policy has undergone a paradigm shift over the year, because with the adoption of what is called the external sector policy, a policy of market determined exchange rate, a policy of management of balance of payment, this has to be factored into in reserve management. The traditional approach to reserve management would be inadequate when a large number of transactions and payment liability arise in area other than import of commodity. Thus, the liability may arise either for discharging short term debt obligation or servicing of medium term debt, or both interest and principal. The committee recommends that while determining the target level of reserve, due attention should be paid to payment obligation in addition to the level of import requirement. So, we have to take care both short term liability management, which may be in the form of payment of principal, may be payment of interest rate. At the same time, we should also take care our import requirement. So, import requirement and short term liability management should be the primary criteria for deciding the optimum level of foreign currency. So, then question is here, with the introduction of market determined exchange rate in 95-96, a change in the approach to reserve management was warranted, because it is not the payment only, the obligation or payment of import is the only policy the reserve management should do. Here, because we are at present as a market determined exchange rate. So, market determined exchange rate, market may devalue the rupee, depreciate the rupee or appreciate the rupee. The investor may attack the rupee in a speculative purposes. You have to take care of that also. So, with the introduction of market determined exchange rate, a change in the approach to reserve management is required. The emphasis on import cover need to be supplemented with the objective of smoothing out the volatility in foreign exchange market, because rupee may be highly volatile. A volatile rupee lead to create instability in the financial system. It may affect the export, it may affect the import. So, volatility you have to address the volatility of rupee also as a part of reserve management, because the East Asian crisis, that East Asian currency crisis in 95-96, that time we have experienced the unstable volatile cross border capital flow, because this unstable volatile cross border capital flow create uncertainty in foreign exchange market, and uncertainty in foreign exchange market create instability in the overall economic position. So, we have to understand the size of the reserve, the quality of the reserve, also, and after that you have to take care the reserve management. It may happen our reserve is not adequate in nature, it may be unstable reserve, it may compose of mainly such kind of foreign exchange reserve which are highly volatile in nature. It may be composed of only FI investment which are highly volatile in nature. It may be composed of NRI deposit which also can be withdrawn any moment. So, the stability of reserve, that is the quality of reserve, also important while deciding the optimum foreign currency requirement. So, the overall approach to reserve management of foreign exchange should reflect the changing composition of balance of payment and liquidity risk associated with the different type of flow. Because as we discussed that in current account, the stability come from the export earning only, stability come from the some kind of tourism, some kind of interest earning, dividend earning. But in case similarly in case of capital account, stability come from the FDI earning. So, other account, other segments of revenue earning, other segment of foreign exchange inflow are unstable in nature. They may have liquidity risks, and this liquidity risks need to be addressed in reserve requirement also. So, the overall approach to reserve management or the foreign exchange reserve management should reflect the changing composition of balance of payment in the liquidity risks. Thus, we have to give more importance to stability of reserve as the center of discussion of foreign exchange and reserve requirement. Similarly, when you discuss about optimum reserve, there should be some criteria of deciding the optimum reserve. But you have to see the policy for reserve management should be built upon a host of identifiable factors and other contingency, which include the size of current account deficit, the short term liability, current account repayments obligation, long term loans requirement, the possible variability of portfolio investment, unanticipated pressures on the balance of payment arising out of external shock, the movement in repatriable foreign currency deposit of non-resident. These are the some kind of items, some kind of segments or some kind of factors which we should discuss while deciding the optimum foreign exchange earning, because what is the size of current account deficit the country can absorb, because excessive current account deficit may depreciate the rupee, affect the internal domestic stability of the country. So, we have to understand what is the optimum size of current account deficit we can observe. Similarly, you have to understand what are the short term liability the country going to face risk. Similarly, the current account repayment obligations, because we might have taken long term loan, short term loan, this principal repayment, the interest repayments are a liability for us. That it may happen that our foreign exchange reserve might be having a huge amount of portfolio investment. The portfolio investment variability or volatility of the portfolio investment should also be discussed. Similarly, there may be some what is called the external shock in the economy. The external shock or all the world may be in the recession. The recession factor affect our export earning. It may happen that there may be our foreign exchange earning which is significant part in the form of a workers income, that Indians are working abroad, they may repatriate the NRI deposits. So, it may also affect our foreign exchange reserve. These are the factors who need to be discussed while deciding about the optimum foreign exchange reserve. So, reserve management has need to be shifted from a single indicators to a multiple indicators, because it is not only the how much foreign exchange reserve is there and how many month of import we can get out of the foreign exchange reserve. It is not the only criteria or deciding the foreign exchange reserve. Some single criteria of import coverage to a multiple criteria of unanticipated changes in foreign exchange reserve should be factored into account while deciding the optimum foreign currency reserve. Then question, which are the criteria? The criteria here, we have to develop a different criteria. The criteria is our money based indicators. The question, domestic money supply also affected because of foreign exchange reserve. So, how much domestic money supply should be there? Their foreign exchange reserve supposed to be one of the linkages, one of the factor to decide the monetary management. So, here money based indicator is very important. So, what is the money based indicator? Forex reserve to broad money provides a measure for potential of resident based capital applied from currency, because how much M3 is a broad money supply, and Forex reserve to M3 provides a measure of potential for resident based capital applied from currency, because it may happen when depreciation of currency, rupee inflations are there. High inflation in India lead to outflow of foreign currency. High inflation in India lead to may have real earning power of domestic foreign currency may reduce. That lead to outflow of foreign currency in India. So, we have to understand money based indicator indicate the ratio of foreign exchange reserve to broad money supply. An unstable demand for money or the presence of weak banking system may indicate greater probability of such capital applied. However, in country where money demand is stable and confidence in domestic currency is high, domestic money demand tend to be larger and reserve over money ratio relatively small. So, this kind of indicator is not applicable to a country where the money demand function is very stable in nature. The country has a confidence in domestic expansion, the country is a growing country. So, this indicator is not a ideal indicator. However, this indicator indicates some kind of capital flight if the excessive money supplies are there in relation to foreign exchange reserve. Therefore, while a sizable money stock in relation to reserve prima facie suggests a large potential for capital flight out of money, it is not necessarily a good predictor of actual capital flight. So, we may consider this indicator of capital flight. However, in a country where potential development potential is there, a country where money demand function is stable, a country where confidence is there in domestic expansion process, domestic banking system confidence is there, this kind of indicator may not be true. However, this indicates some kind of instability in having a large money supply in relation to foreign exchange reserve. If you see in Indian context, the money indicators I have taken into account the foreign exchange reserve from 1991 to 2011-12. Similarly, I have taken the broad money supply and I have taken into account the amount of foreign exchange reserve, and I have estimated the ratio of foreign exchange reserve to money supply. The ratio I have taken into account. I have divided the period into two parts. The one part is called 1991 to 2001, the part of what is called reform measures, and second part is 2001 to 2002 to 2012, that is consolidation phase of reform. And then two different period, what is the nature of this money based indicator? If you see the money based indicator here 1991 to 2001, the money based indicator forex reserve is growing. At the same time, the broad money supply red color is also growing, but if you see the green color line, that is green color line indicate the Forex reserve to broad money supply. This has been fluctuating over the year and it was quite high in 95-96, which has reduced significantly to nearly 300% in after 2000, that is 97-91, it continued to decline. This indicates secondary axis indicate the reserve percentage, that is Forex reserve to broad money supply. Primary axis indicate, this axis indicate the millions of foreign exchange reserve in US dollar, and the US dollar amount is increasing, the broad money supply also increasing, and at the same time that ratio of foreign exchange reserve to money supply also is quite high up to 2095-96, after that it continuously declining. If you see the 2002-2012, the reform that consolidation phase of reform, that part also if you see the graph here, that graph also indicate the line blue, the red line is indicate what is called the broad money supply, and the Forex reserve is a blue line increasing over the year, and this indicate that green line indicate the Forex reserve to broad money supply, this also declining over the year. Is also declining over the, it was quite high in up to 2008-9, after that continuously declining, and indicate that there is increasing strength in our domestic economy, there is no capital flight because of the excessive money supply in the economy. The other indicators are there, trade based indicators. Trade based indicators is import coverage, primarily import coverage. Trade based indicator, usually the import based indicator defined in terms of reserve in month of import cover. How many month of import cover is there because of foreign exchange reserve? How many month without any earning, how many month you can sustain with the existing reserves? So, that is called number of month of a country can continue to support its current level of import if all other inflow or outflow cease to exist. As a measure focuses on current account, it is relevant for small economy which have limited access to foreign exchange and also high vulnerability to capital market. For substantially open economy with a sizable capital account, the import cover measure may not be appropriate. However, a country like India, where foreign import requirement is essential in nature, the oil imports are there, this also indicate a good sign, good indicator for assessing the foreign exchange reserve requirement. If you see the import coverage over the year, same 2 period that I have covered, it was quite negligible in 1991, only 2 months, nearly 3 months of export, 3 months of import requirement, that much of foreign currency you had in 1991. And over the period with the liberalization of foreign exchange market, with a significant inflow of FI, FDI, invisible foreign exchange inflow, this has been increased over the year, and it was in 2000 and 2001, you have 10 months of import cover without any foreign exchange earnings. The existing foreign exchange can allow us to import 10 months of import. And if you see the graph, the blue line of foreign exchange reserve, the red line is the import requirements, and the green line indicate how many months of import you can have over the year. This import cover we have, and this has been increasing over the year. The secondary axis indicate the number of month, and up to 10th month of import cover we have up to 2001 and 2001 10 month of import cover the foreign currency reserve was having. If you change it to 2002-2012, this import cover has, though it was quite significant, if you see 2003-4 we have 17 month of import cover, which has been declined after 2007-8. 2007-8 onward declining because the foreign exchange, the export was declining, import has increased significantly because of oil price rise increase, and also FDI, FI sources has declined, and foreign exchange reserve also fluctuate because during this time because of the world level crisis. If you see the graph, the import cover is declining over the year, and at present it is only 7 months of import cover you have. with $300 billion we can cover only 7th month of import. If there is no further earning, this is an alarming situation. This situation is not good. You have to increase our export so as to pay for our import. Any other indicators are there? The other indicator here, debt based indicator. What is debt based indicator? Debt based indicators are recent origin. They appear the episode of international payment crisis. If a country short term debts are quite high, the sovereign rating will be reduced, because short term debt you have to repay immediately. If you do not repay, the sovereign rating will be negative and it creates capital flight. So, we have to cover the short term debt through our reserve requirement. So, short term debt by remaining maturity provides a measure for all repayments of non-resident Indian coming over year. The non-resident Indians deposits are there, they are short term in nature. The short term deposit, the non-resident Indian may withdraw the money anytime. So, you have to pay them. So, short term, how much foreign exchange reserve we have to cover the short term debt. If you see this indicator over the year, short term debt, we have significant amount of reserve to pay for our short term debt. In 2001, we have in 2002 68% of our reserve because of short term nature, which has increased to, because we can pay for our our foreign exchange reserve can pay only 68% of short term debt, which has increased to nearly 1165%, because we are significantly sufficient to pay for our short term debt. Similarly, in 2002 to 2012, similarly short term debt, we have significant reserve is there to pay for our short term debt. So, there is no fear in repaying the short term debt. However, if short term debt is added with the import requirement, then all are short term liability in nature. So, short term liability also part of the reserve requirement. So, this is the ideal indicator of foreign exchange adequacy to understand, because short term liabilities are short term debt repayment and our import coverage requirement, and these two together call short term liability, and short term liability is an ideal indicators of foreign exchange adequacy to understand. So, how much foreign exchange reserves you should have? You should have that much of foreign exchange reserve which can pay for our short term liability. So, foreign exchange reserve to short term liability is an ideal indicator. If you see the short term liability to foreign exchange reserve, that in Indian case in 91, 92 to 2001, in 91 only 32% of our reserve, 32% of our short term liability covered by the reserve foreign exchange reserve. So, say 68% foreign exchange reserve is not covered. So, 68% negative we had, but over the period liberalization and inflow of foreign currency, the short term reserve in 2001, the short term reserve, short term liability and foreign exchange reserve can cover 672% of short term reserve. So, we have adequacy of reserve that up to in 2001. So, this adequacy reserve started after liberalization, and 93, 94 into if you see 93 data, this data 93 data, you see 100%, this 100%, because that much of foreign exchange you had which can cover our short term liability. Short term liability nothing but short term debt payment, that debt repayment and all plus foreign exchange import requirement. These two together 100%, and our foreign exchange reserve is equivalent to short term debt requirement. However, after that our foreign exchange reserve increase, our short term debt requirement decline over the year, and we have 72% requirement. So, in 2012 also 2 to 12 we have significant amount of short term debt requirement. However, it has been declining over the year, and this alarming situation has come in 2011 12 onwards, because twice of the short term debt, that much of reserve we have. So, we have to increase our foreign exchange reserve further. And what is the reserve adequacy? we have significant amount. Reserve adequacy, you understand that it is evolving concept. The reserve adequacy requires we have to factor the traditional view of import coverage or single factor determinant to a multiple determinant you have to develop. The multiple determinants would take into account the not only the reserve import cover, but also the stability of the reserve. You have to take into account the short term debt repayment, you have to take into account the money based indicator, you have to take into account what is the debt repayment services, you have to take into account the possibility of intervening in foreign exchange market whenever there is a instability in foreign exchange market. So, with the stability of reserve, you have to understand that this has the reserve adequacy over the period has changed. In Indian context, the short term liability to reserve requirement is the ideal indicator for understand the foreign exchange reserve adequacy. And if you see the reserve adequacy in the form of short term liability, it was 32% of reserve requirement, 32% of liability covered by reserves. However, it has increased to in 91 it was there, it has increased to nearly 200% in 2012. However, at present we cannot say our foreign exchange reserve is adequate in nature, because the composition of reserve is very important. Our composition is not stable in nature. Our own earning, that earning of in the form of export is not significant in our foreign exchange treaty. So, our actual foreign exchange reserve is highly unstable. It is more towards in the form of invisible, in the more towards in the form of what is called FI investment, which is not stable as far as their history concerned. So, we have to develop a reserve adequacy which is more stable in nature, which is more earning in nature rather than a debt, rather than a investment in our country. So, with this let me complete this, and you can go through the handbook on Indian economy by RBI. That the handbook provide all data on foreign exchange reserve side, composition side. You have to take into also discuss something I have taken into account from annual reports of RBI, various issues. Also, I have taken into account something from currency and finance of RBI, various issue. Economic survey of planning commission also indicate the requirements of foreign exchange reserve. And the model question I have designed for you here: what do you understand by reserve adequacy? Here you discuss what is actually meaning of reserve adequacy, various criteria of reserve adequacy you have to discuss there. Also, we describe various indicators or assessment of reserve adequacy. We have discussed there is assessment various criteria or indicators of reserve adequacy, the indicator of money based indicator, the indicator debt services indicator, short term liability indicator, trade indicator. We discuss about that. In the Indian context, do you think the current level of foreign exchange reserve is adequate? You have to estimate the various criteria of reserve adequacy, and along with that you factor instability, composition of foreign exchange reserve, that stability part of the foreign exchange reserve, and decide whether Indian context the current level of foreign exchange reserve is adequate in nature or not. Thank you.